we are actually positive on Indian equities from a 2 to 3 year perspective. And the reason why we are positive is because we think that there are two or three things happening in the market today, which we haven't seen happen in the last 10 years. First of all, we see a decent chance of a capex cycle happening in India. Second, the real estate sector is in the process of bottoming out. And finally, the salary hikes are finally coming through. So on net balance over the next 2 to 3 years, we think that there is a good Indian earnings upgrade story that is about to unfold. However, we think that the near term is likely to be fairly volatile for 3-4 months more as compared to what we are used to. And the reason why the near term is expected to be volatile is predominantly driven by interest rate regime change, transient concerns on inflation, and finally geopolitics. We think we are somewhere towards the peak of those concerns, though not fully there, and hence we will be conservative over the next 3 to 4 months. But after that, I think the earnings upgrade story that I highlighted earlier should actually play out, leading to a more constructive view on markets. Three things in particular. First of all, the interest rate regime change. We are moving from a declining interest rate regime to an increasing interest rate regime globally as well as in India. Usually when that happens, it leads to quite a few changes in investor mindset, in investing style change, and also how investments are struck. So that's the first. Second, over the last year or so, we have seen supply chain related disruption affecting quite a few sectors. This has led to inflationary condition and kind of is flowing through the economy and impacting consumers and other sectors as well. So that is the second reason behind the volatility that we are seeing. And third, the geopolitics, the Russia-Ukraine war, and the headlines that it makes day in, day out don't make particularly great reading. So these are the, in my opinion, key reasons why the markets have been volatile over the last few months and probably will continue for a few months more. One of the fundamental tenets of investing, which I like quite a bit, is invest when there is a famine outside and reap when there is a feast. So if I look at the headlines, it consists of recession, it consists of high inflation, it consists of negative news flow on geopolitics. When lots of negative news are there, equity markets or equity share prices are usually depressed. And that is the time when actually investors should think about putting money to work rather than shying away. Of course, the pace at which they put it work should be more gradual rather than all in one. But having said that, given what I highlighted about the medium-term outlook that we have of equities, we think this is the time to gradually, steadily get constructive on equities rather than running away. We are particularly positive on the outlook of capital goods, industrials, and in general, if I may call it, domestic cyclicals. Secondly, we are also positive on real estate sector and indirect plays on real estate overall. And finally, we see credit growth in the economy improving, so we are positive on lending financials as well. So those are the areas where our portfolios at Edelweiss MF, we are overweight, and we think they have better prospects ahead. Clearly, it's time to invest and to redeem. We think that investors, particularly with long-term investment horizon, should consider in tranches investing in focused strategies which are focused on wealth creation and overall invest accordingly. We think that overall focused investing is a good way of putting money to work. We are certainly kind of about to launch a focused fund in that category. That could be one of the alternatives to think about. But even otherwise, investors with long-term horizon should think constructively about equities than and putting more money to work rather than redeeming, or for that matter, taking money away from markets. Absolute levels of equity markets and forecasting them is a fool's game. I would say directionally, we would expect markets to be volatile in 2022, and we see 2022 as an investment year. However, we think that next 2 to 3 years is a very fairly constructive time for India, both with regards to its own history and also in the global landscape. So we are fairly positive medium term. Near term could be a bit volatile to kind of to be mindful of. Think about investing when you see a famine outside. and think about taking money off the table when there is a feast going on. So that means when times are tough, when headlines are negative, usually share prices are depressed. That is a good thing, a good time to actually incrementally put money to work rather than running away. So be constructive, stay patient, and always remember time in the markets is far more important than timing the market.